Hi, I'm Cotton Candy TA, and welcome to my Ultimate Stop Loss Guide. This guide is going to be the foundation of all the decisions you make, whether you're an investor, somebody who just trades from time to time, or an active day trader. You must learn and master the proper way to use a stop loss. Not only will this guide help you reduce risk across all markets, it's going to be a cornerstone for every decision you make to give you complete control while reducing risk as much as possible. Sometimes you can even reduce risk to zero. However, in order to do that, you must understand how the mechanics of stop loss is used as a professional trader. The goal is to have complete freedom in the markets by having no risk associated with trades. We can achieve that by creating an engine and a system using the most advanced mechanisms and techniques used by the most elite traders in the world to reduce risk to zero, low risk, sometimes medium risk, and even high risk by choice. Now, these all carry and have their own unique scenario that they're used. However, we are going to build out every single scenario so that you can have complete control over all of your trades and investments. Sounds simple, right? It's not. Trust me, this is going to be a very complex and mechanically advanced guide in terms of theory and the things we're going to be talking about. You may not be able to keep up with every term I talk about, but that's okay. Try to follow the logic flow that I create. And if you want to learn more about the terminology that I use, you can go and check out all my free courses. I have hundreds of videos on my YouTube page that are free, that go over through multiple courses, technical analysis, procedural analysis, comparative analysis, mental analysis, mind training. I have hundreds of videos out there to help people become professional day traders, and they're all free on YouTube. I also have a Discord community. We're talking to each other daily about different trade ideas, helping each other, having laughs. I even have a professional major in psychology there, helping us with a mind training center where we go through techniques to strengthen our daily routines. Again, I'm proud to say it's one of the best Discord communities in the world for day trading, and we have a great time. You can join up by signing up to my Patreon if you want to have access to it. Otherwise, check out the videos, start there, join the community at the same time, all that good stuff. This isn't going to be a guide that shows you how to click buttons or how to operate your exchange in terms of, hey, I trade on Binance or I trade on FTX or insert exchange here. This is how you execute a stop loss. There are thousands of guides out there for that, and there are thousands of exchanges. I could never possibly get through even a percentage of the different exchanges and how you actually execute these stop losses. But this is very simple. It's just clicking buttons, entering numbers, and there's tons of tutorials on there about how to actually use the software. This is not a software how to use class. This is an advanced stop loss guide to help you protect your account and make you a professional trader. I'm going to be using terms like hold levels, origins, locals, globals, legacy, reverse levels, data points. I'm going to be using this whole glossary of terms that I've created throughout my courses. Again, you can keep up with this without having taken my courses, but if you want to learn about them and how to be an actual real day trader and how to be one of the best in the world, go take my courses. Easy. So where should we set our stop loss, Cotton? Great question. You're only ever going to put it on one of two things, either a level or a trend. The only difference is that a trend, the proximity to where your trigger point is versus where the actual trend is, changes over time due to the angle of the trend. The longer of time frame that you're in a trade, the angle of the trend is changing and either shortening your target or lengthening your target. So for this reason, due to the proximity of the way a trend works, because it's on an angle, as time goes on, you need to constantly readjust a trend stop loss. And those are the two and only two things we will ever use stop losses on, trends and levels, with one minor difference. A trend needs to be constantly adjusted, where a level, you kind of set it and forget it. For this reason, we must always dictate this as step number one. Are we using a level or a trend in a stop loss? So step number one, do we use level or trend? Simple enough so far, right? Good. Step number two would be categorizing the amount of risk you want to take. Now you have everything from no risk to low, medium, and high risk. They all have a different use case in why we would pick a low, medium, high, or no risk stop loss. At first, it might sound like, well, Cotton, I only ever just want to have no risk in trades. And this is achievable if you trade a certain type. And we are going to be dissecting and talking about these as we go on. At first, I'm just going to briefly talk about the types of risk that you would have and what the use cases might be. First is the no risk stop loss. This is used when your accuracy is extremely high, and the use cases for this would be something like a knife catch, a ladder point, a final hold level. This is typically used by high leverage traders, 50x, 100x, derivative traders who are using massive amounts of leverage and want to have no risk associated. Now, when we say no risk means as close to zero as you can get. Sometimes you will have a little bit of money that it costs to execute these trades, as you're going to have fees on your exchange to actually execute the trade. Now, on some exchanges, it's $10. On some exchanges, it's a percentage of your actual position size. This is all dictated by the exchange, so not worth going through the little minutiae and criterias that would be the fee, as we call it. So a no risk stop loss would be, you didn't lose any money, you paid your fee. Congratulations, you executed a trade without any risk. Next up would be a low risk stop loss. This allows for 1 or 2 additional levels to be hit by your actual stop loss target. And its use cases would not be wanting to miss a move because your confidence is high and you have multiple levels backing each other up. This is best used by spot traders and low leverage traders. It can also be used by high leverage traders as well. So this has a very wide criteria of who it's used by and a very small criteria in terms of its use case. Next up is the medium risk stop loss. This is a crutch for brand new traders. This is something that we phase out as we get better as traders. A medium risk stop loss doesn't really make sense. You either want to have low risk, no risk, or high risk. They all uniquely have their own scenarios and use cases, but I see this the same way as I see trailing stop losses. It doesn't really make sense to use a trailing stop loss because you're admitting that you can't find the right target. By taking a percentage of your position out, you're saying to yourself and the markets that I'm not really sure where this thing is going, but I want to lock up profits. You should always know where a trade is going. You should always have your plan planned out. So a medium risk stop loss and a trailing stop kind of fall into the same criteria for me and bracket. These are crutches for brand new traders. These are things that as you get better, you will phase them out of your agenda as a trader. I don't want to see my professional traders using trailing stops, just like I don't want to see them taking medium risk. We take high risk by choice or we take low risk by choice. Being somewhere in the middle just means that, hey, don't really know what I'm doing, but I kind of want to have some safety. Well, the good news is that with this guide, you can phase that out and become a better trader. Now, before we move on to the final type of risk-assessed stop loss, I just want to say that if you were to use no stop loss at all, this would be catastrophic. You should use a stop loss on every single trade. And if you're unsure or not good enough yet to use low risk or no risk or high risk, you start at medium risk as a stepping stone. This is leaps and bounds better than not using a stop loss at all. And if you are a newer trader, medium risk is the perfect starting point that allows you to have an anchor to say, okay, here's where I am right now. We're right at medium risk. If I wanted to increase my risk, I would be doing it because of reason X. If I wanted to reduce my risk, I would be doing it because also, again, reason X. So as a beginning trader, using a medium risk stop loss is absolutely perfect. It will help you learn how to gauge and reanalyze your stop losses and become better. So before we move on to high risk, I just want to make sure that everybody knows you must use a stop loss at all times. And if you're not sure where you fit yet, start with medium. And as you get better, as you level up, as you become a better day trader, and as you become more advanced and accurate, you can then shift medium on this side to high and this side on low and pick the appropriate one for you in that given scenario. The final type of stop loss on our list is the high risk stop loss. The use case for this would be maybe a hard close hasn't established or a deep dive potential is high. This is best used by high leverage traders as they understand the move more complexly and have a deeper grasp of what's going on in the charts. Now that I've blown your ears off about stop losses and set up some initial parameters, let's go to the chart so I can show you how, why, what, where, when, and basically everything you'll ever need to know about stop losses with examples and walk you through them. Okay, let's now go through some examples. In this scenario, we're going with the no risk trading scenario. So we've identified a few levels here. We've identified a 15-minute hold level, a 5-minute reverse level, and a trend. So on my screen, you can see three levels where you can make a decision to say, okay, I'm going to buy this level with a stop loss here. I'm going to buy that level, etc. So the very first and foremost would be the no risk stop loss. This is the stop loss that has almost no risk other than fees. This is going to be used by high leverage traders because it is going to be the greediest part of the charts. So as we see three levels here, again, we have this first level here as a 15-minute level. We have the trend here, which also gets tested. And then we have the third and final level. Whenever you're using a no risk stop loss, you need to identify the greediest parts of the charts to enter the trade. This means that the chance that you miss the trade is going to be higher. However, when the trade executes and hits, it has almost no risk. So if you want to use no risk stop losses, the most critical and important thing is identifying that it's the greediest level first. Again, we can go over this level real quick here. You've got a 15-minute hold level right here. You've got a 5-minute reverse level, which can be seen right there. And then this is just the trend that is supporting the move. And I believe this is on the hourly, if memory serves me correctly. Take a look here. And it is indeed on the hourly distribution to distribution. So as we go back to the trade now, we take a look. If you were to use a scenario where you have no risk, you're always and only ever taking the greediest level. This is how you achieve no risk. And this is why high leverage traders such as 50x or 100x don't really care if they miss trades. They're only willing to take the spots where they know that that's kind of the final price that will support the actual level. The final point in the move before everything completely goes down, right? The point of polarity, the last moment in the chart. So if you can find these last and final moments, you will there have found your spot where you can enter the greediest, highest leverage trades with no risk. So let's hit play, see how this plays out here. We'll stop it right there. You can see that the first level is hit pretty perfectly, moves up, goes down to trend, sees if it can hold trend. If you are using a no risk stop loss, you wouldn't be in this trade yet. And if the trade simply misses because one of these other levels holds it up, that's perfectly fine. This is the trade-off of using a no-risk stop loss, is that you only use no-risk stop losses on the greediest levels. And the reason why we use no-risk stop losses on the greediest levels is because we're willing to let the trade get completely missed, and we understand that this is the final point of polarity in the move. So as we step forward in the move a little bit here, hits the trend again, the move rejects. We realize that this is where we enter our trade and we let the trade establish and run with almost no stop loss. Because if it loses this level, the move is going to completely run the other direction. It's a polarized moment on the charts, and if it loses this, it's going to just sink to the floor. So this is where you find your no risk stop losses, the greediest levels on the chart that hold up the highest points of polarity. And again, by polarity, we mean the final levels before something completely runs in the opposite direction. The final level of support, the final ladder point, the final reverse level, one of these things that can dictate a point of polarity on the charts. Your confidence would have to be pretty darn high knowing that that level would be hit. You can also use a low risk stop loss here. So the choice is kind of yours when you assess these moves. Do you want to use no risk and go for the greediest level? Well, you run a high risk of missing this trade as it becomes a pretty big knife catch, right? So do you want to run the risk of missing the trade and have no risk on the trades that you may possibly miss? Well, this is a choice you have to make as a trader. Our job is to mark out the levels, pick the one that we think is going to support and hold the move up, and then set a stop loss appropriate to the type of level it is. So now for that reason, we're going into the second scenario here, which is a low risk stop loss, where a low risk stop loss means you are willing to take a trade. You think it's going to move up still, and you have different levels that can support it below. You have your first level here, which could be where you enter the trade, and you say, hey, there's one or two levels pretty close. This one is 0.3% away, and this one is 0.68. There's a few levels pretty close to back me up here. So I'm willing to put a stop loss where you would say, okay, well, the risk is limited to about, 76% here, or 0.76, less than 1%. Now, this can be very high risk if you're a leverage trader or very low risk if you're a spot trader. But the reality is that you know that you've got a few levels below you. So you would enter your trade here, and you would set your stop loss down here. Just like in the no risk trade, your stop loss would actually be in the exact same spot on that exact same line. So if you were to take your trade from here to here, your stop loss would actually be in the exact same spot where you're paying a very little to no amount of money on this trade, pretty much just covering your fees on the trade. So the spot where you actually stop out is the same. The difference is if you're entering on the higher level up here, you're willing to take a little more risk because you want the trade to possibly move up before the final target is hit. Now, please note that there's no guarantee that this final level will get hit. And that's why you have leverage traders and big 100x derivative traders, 50x. That's why those traders only ever take the greediest levels. There's no guarantee that they're going to hit, but when they do, they hold up the entirety of the move because they could become points of polarity. So the decision here doesn't become, do I want low risk or no risk? Because let's be honest, we would all pick no risk all the time. The decision becomes, is it going to go after this level or not? If you think it's going to go after the level, use a no risk strategy. If you're not quite sure and you think that the move is going to bounce up once it hits a point like this and the move is going to go up, well, I think a low risk stop loss and a low risk entry would be the right play here. You could either enter on the first level or the second level because you think the third level is not ever going to get hit. So you could enter on the first level with a stop loss at the second level, or you could enter at this second level. And by level, I mean trend, because trend is a level 2. So let's be very clear about that. We could enter on the trend as level number 2. So we could enter on the trend as level number 2, saying that level number 3 is going to hold us up. So this type of stop loss is used when you think a move is going up and there's multiple levels of support underneath you that can continuously bounce the target. And this is where you can achieve low risk using a stop loss. And again, just to reiterate, it's the same mechanism. And the decision becomes, do we want to use low risk with lower leverage? Or do we want to use no risk with higher leverage? If you want to use higher leverage and have no risk trading, then you're going to have to pick the greediest levels. And they're not always guaranteed to hit. So it becomes a decision between flavor and taste of the trade on what you like to do. But this is how you would assess whether you want to be in a low risk trade or whether you want to be in a no risk trade. And then you can use that as a pillar decision to how much leverage should I use? Well, here's a good tip. If you were using ultra high leverage, you would never go into a low risk stop loss trade. You would go into a no risk stop loss trade, or you would not enter the trade at all. So if you're sitting there and saying, hey, I want to use 50x or 100x, and you're saying, I want to enter no risk, you don't have a choice here. The choice gets taken away from you. Your choice is given to you instead of you picking. Your choice becomes, what leverage do I want to use? If it's ultimately 100x leverage, you take no risk trade only. If you're using spot or small margin, like maybe 5x, low risk would be perfect here because it allows you to lose almost no money on a lower leverage while having multiple levels of support to hold you up. And your stop loss is calculated in such a way that you've risked the least amount of money with the highest potential upside. So if we were to just hit play here on this trade, you can see that it simply moves up and your trade, whether you're still in it or not, executes. And now it's up to you what you want to do with it. But the stop loss has correctly been set. You've assessed the levels properly. And now you can move forward in making that decision between no risk and low risk. Okay, let's go to another example. In this trade, we've marked a few levels out. We've marked the 15-minute greediest point, which is also potentially the ladder point. We've marked the 15-minute backside. And inside the upper range, we've marked the 5-minute hold level. So we have 3 levels here. Now we're going to, before this trade gets hit, talk about what we could possibly do. Okay, let's go to a no risk scenario again, where you're going to use big leverage and you're going to say, okay, let's analyze the bottom part of this. So we're going to start breaking this into subcategories as to where this is a 5-minute and these are 2 15-minute levels. We can also now mark the 5-minute backside level and the 5-minute frontside level. So if we wanted to take a no risk trade or a no risk stop loss in a trade, we would be looking down at the greediest part of this move. Again, let's just go over these levels real quick. We have a 15-minute backside. We have a 15-minute front side. Inside of this part of the move, you have a 5-minute hold level. You have a 5-minute backside and you have a 5-minute front side. So you have a bunch of different levels and even potentially an origin level right here, which we can mark instead of the backside as kind of the origin breakout point. So you have all of this information on your screen. Instead of deciding what type of trade you should do, this is very simple. Actually, this is a shortcut to every decision you need to make because you will understand which level you're going after dictates not only how much leverage you should use, but where you should also stop in the trade. And I'm going to talk about that. Let's say, and we're going to go to back to the 15-minute charts here. Let's say we wanted to use no risk, high leverage. We automatically ignore all of the levels in the upper range because there's too much of a difference in terms of liquidation on high leverage. You're going to get liquidated or risk way too much money for what it's worth in this trade. You're talking about risking a full 100% in this trade on 100x leverage or which is twice over liquidation or liquidation on 50x or even in a really bad scenario on something as low as 20x. So if you are going to use leverage in this trade, you cannot go after this level. Instead, if you're wanting to use high leverage, you immediately take this off the chart. So we can take that off and we can even measure this one here and say, hey, what's the difference here? This is way too high risk. You're talking about losing 67%, which is liquidation on most platforms for a 100x trade or half of your position on a 50x trade. That's insane. You would never risk that. So you can actually immediately, if you're using high leverage, take this off as well. and then just diminish it down to, okay, I'm using high leverage. There's 3 levels here. Now we can get into a scenario whether we want to do a no risk trade or a low risk trade. The no risk trade would be the greediest level. So you would go to your 5-minute chart and you'd say, oh, I want to put big leverage on this level here. And my risk would be almost nothing, because if this loses its move, it's actually losing the entirety of the range and going to back target something in a much further time zone, way the heck back there somewhere. It's actually losing its range and it's going to dump way down. So it's not a trade I should be in at all. This is not about how much percentage does it lose before it goes back up. This is a matter of it's lost its range. This thing is plummeting until it recovers. So you're not going to be wanting to be in this trade. So immediately we can take this information with these levels and say, okay, I'm going to have no risk on high stop loss. We only have one option here then, which makes it very simple, which you just say, hey, I only have one level to buy and our risk is very low. So we can stop pretty close to target here, giving us a no risk trade with the highest chance of success. Beautiful, isn't it? Now, if we do the same thing and we go back to this example and have those levels remarked, we can also do the same thing with a low risk scenario in this lower range. So if we were now saying, hey, we want to do low risk because we know one of these levels are going to bounce it, but we're not quite sure which one it's actually going to target and go after, well, maybe we should start measuring the amount of risk associated with this. So now we can say, okay, well, if it supports 2 levels, it's 0.11%, which is pretty low risk. If it goes after all 3, it's 22. So if you're comfortable with that low risk as 0.21, depending on your leverage, you would now use low risk stop losses because your stop would actually be in the same place. Again, it would be somewhere close to down here where the range is lost and you've had the highest chance to be in a successful trade while holding the range by continuing to ladder it off of the hold levels or a ladder point or a trend, some type of level inside of here. So again, this now makes your choice very simple. You either enter with lower leverage on one of these higher levels where you feel comfortable as a low risk trade, or you go for no risk and you completely take these out and you just say, I'm going on the greediest level. I'm going to use higher leverage. And now my stop loss is very close to where this thing is polarity and it has high amounts of chances to either succeed or fail. So the common tone now in these lessons becomes polarity. Finding the greediest moments on the charts leads to finding the polarized points on the charts, which is the exact opposite direction of what it's going to go. It's either going to go and fire down to its greediest target and bounce up, or it's going to hit that greediest target, fail it, and have a complete collapse down, the way that all stock markets work. They go after these points of polarity, these data points, and they either support them as continued ladders, or they completely fail and start going the other direction. So this now takes all guessing out of what type of leverage should I use and where should my stop be? Because these things are actually dictated by the levels and not even a choice of preference that we make at this point. They're just, hey, how much could I lose? Oh, this is the type of stop loss that I use because that's dictating the trade. Let's now, instead of saying high leverage, we go and we look at the entirety of this list. Okay. Now we have different points that we can decide. And if we go to a 5-minute chart here, we can see backside, front side, all those same levels still apply. We can mark them back on the chart and we can go after different points with different leverage. Let's hit play to see where this thing goes. Okay, it hit the 5-minute level. This is a scenario where if you wanted to take a level this high, you would be doing it with a small amount of margin or almost spot. Because the trade level is so high, because the range is so high up, you have a lot of room to move down. So if you were going to be in this trade, you would use very low risk. And the reason that you would use low risk here is because the amount of drop it can have is substantial. So this would be a low risk scenario or a no risk scenario where if you were entering this trade, your stop loss would be right here, just the same as it would be down here, because it loses the range and the amount of a gap it can have is going to either liquidate your account or you're going to lose unnecessary money. So this becomes the same type as this guy down here. They become no risk trades because of the amount of a gap between the two levels, the amount of difference between the bottom of this range versus the bottom of this range. So just because price goes higher doesn't mean you can't still use a no risk stop loss. A low risk stop loss would be something like this, where it has a level here, but it also has another level to support it down, where you can measure the difference between these two and say, okay, well, I believe it's going to move up, and there's about 0.3% in this that I'm willing to take risk on in terms of levels being hit. Okay, this would be low risk with lower leverage. And if you didn't want to use low leverage when you wanted to use high leverage, again, your choice is already made for you. So this is where the beautiful engine gets created with stop losses, is when we can dictate the type of trade and the type of stop loss just by using the measuring tool. So now we're building something really special, because now we can see where we don't even have to do a lot of thinking. We actually just have to understand the architecture in a chart and the way the polarity points work in order to dictate how much leverage we should use, what type of stop loss we should use, and where we should put them, and what we should be willing to accept. So this is going to give you a lot of control and clarity over your trades when you can simply start looking at, hey, where's the greediest points? Can I use those? And how does it dictate my stop loss? Is it higher up and I need low risk with low leverage? Or is it deeper in the move as the greediest point? And I can use high leverage with no risk. Aha, now we're creating something pretty darn cool. Now that you understand the difference between low risk and no risk stop losses and how they can dictate trading and the way that we delimitate that, we need to talk about medium risk stop losses and a medium risk trade. So here's the problem. If you are willing to take low risk, why would you take medium? If you're going after deeper levels constantly in the charts, you're always going after deeper points. You're always going after the deepest points of polarity. You're always going to see these ladder points in charts hit. So in what world would it make sense to take a trade in here as your stop is right here? Well, it wouldn't. You would either wait until this target gets hit as a low risk trade. You would wait till this target gets hit as a no risk trade, or you'd be up here comparing this as low risk versus this as no risk. So now you're kind of getting into this scenario where it doesn't really make sense in any scenario to take a medium risk trade because you're floating between points that can support the charts. So taking a medium risk trade and using a medium risk stop loss, it doesn't make sense. There never is a scenario where I see, hey, this makes sense to take more risk willingly because one of these levels is going to get hit, but it's not going to quite get hit. It's going to float around here and then it's going to move up. Well, if that's the case, you could just take the point that's created right here as a low risk scenario. So instead of trying to float some in-between moment off intuition, you could allow this, even if this does become true, where you hit some kind of intuition moment, you can allow that to create a little valley right here, and you can rebuy that valley for almost the exact same price while eliminating all risk instead of, again, trying to use intuition or some float point or some random interval that's onset by no real information, a data set that doesn't exist, and a data point that would show you a smarter place to buy anyway. So medium risk kind of becomes this crutch. It kind of becomes this point for brand new traders to just have something on the books, because you have to always have something on the books. It becomes this point for a trader to have something on the books where it's, okay, I don't quite understand all the depths of the chart yet. I don't know what the polarity points are. I can't quite see the ladder points yet, but I need to have some type of stop loss on the book. This is for you. This is perfect. Use the best levels you can and use kind of these medium points of risk to associate with a stop loss. Because let's be honest, you can't trade without a stop loss. You shouldn't be anyways. It's a cardinal sin in trading to not have a stop loss. So if you don't quite understand the deepest points yet, yes, use a stop loss and work on finding those better points to identify smarter trades, which is low risk or no risk, depending on the scenario you're in. Okay, now let's talk about the riskiest stop loss, the high risk stop loss. This is by far, without a doubt in my mind, for only the best traders who are willing to take that high risk because they believe in their ability to see the deepest, most onset information on the charts, and they're using high amounts of leverage. So again, just to preset this, this is for the highest skilled traders. I've marked out a few different levels so you guys can follow along. Instead of wasting time and going through them, I just quickly mark them out. You have a 15-minute hold level right here. Inside of that, you'd have a ladder point created off this down here, which creates another ladder here. Inside of that, you would have a 1-minute level here, which acts as the greediest point in the chart. So if you zoom in there, you can see a 1-minute level. And if we go back to the charts at the front of this, put it back to the 15 minutes, we also have a trend. We don't know when the trend is going to intersect yet on this, as if the price comes all the way out here. Obviously, the trend would be higher than the levels. And if it drops straight down, it's slightly lower. And we have one more level here, which is the 4-hour reverse level, creating the valley or the range off of the previous test of the move. And you could even possibly mark one more level down in this range. But at that point, I don't even think it's worth talking about because you'd be so far gone past liquidation. You're not setting a trade with a stop loss up there to stop multiple percentages below. So here's a scenario where we have multiple levels on the chart. You use a high risk stop loss on points where you think extreme moments can happen, and you're not willing to settle for the higher levels. You want to get extremely greedy because you believe there's a big bounce happening. Maybe a knife catch is going to happen on this level, the most extreme points of the chart. So what can happen there is you can have a level get targeted, the first level gets targeted, and this would be low risk. You'd use low leverage because you believe there's 2 or 3 levels below it. So if you think this is going to hit, then you would use lower leverage, and this would be considered low risk because you could stop out right here. Or if you were really good, here, you wouldn't be buying this level. You'd be buying a much deeper level and taking the risk of missing the trade altogether. But if you don't want to miss this trade because you do believe, hey, I'm going to ladder off of this level, which was onset by this off of previous moves, and my confidence is super high because this move is going up. Well, in this case, you'd use low risk, low leverage. Very simple. Nothing to really debate there. If you were going to start down the rabbit hole of saying there's, multiple levels below me and I want to use a higher amount of leverage and take no risk trading, then you would use either the trend on this side here as your stop guide because it's lower than the second level. Like if this went straight down right now, technically it's just a little lower than this level right here. So you would use the trend. Or if you went past this moment where trend is above the level, then you would simply use the level as a no risk point. And if it goes and touches that no risk point, then that's fine. And if it breaks down, you're out of the trade and better off to the next one. A moment where you would use high risk is because you believe there's a level much deeper and you're allowing this to not only break the levels that are present on the actual chart, but you're willing to go after the most extreme moments on the chart where reverse levels exist, where the extreme ladder points, where you've potentially gone and tested even like $1 over this just because it's a ladder point. You'd be willing to take this level with higher risk. You wouldn't want your stop to be so tight. You could have a tight stop in this scenario, hit this level, go slightly below it and bounce right back up, have the right decision point and be out of the trade because your stop loss was too tight. This is something you want to avoid. So as a high risk trader, sometimes we get into these scenarios where we know something is going to support a move. And we do need to assess a little more risk because our confidence is very high. So we say, hey, this is an extreme moment in the charts. It means if this holds, it's going to hold up for the future and indefinitely this is going to move up off a critical major level. Again, in this case, it was the 4-hour level. Oh, come on, TradingView. Don't freeze on us here. Fun, TradingView's always doing that. It was the 4-hour level right there, which you can see. It had multiple attempts in the past to try to close this level. And it had gotten to a point where the last ladder point in the move right here also dictated the trend. It can't really break below this while still holding its move. If it does, then the gap exists down to this right here, where this can be the next ladder point. So if it breaks this, it gaps to here. So you would want to be in a scenario where you're willing to use high risk because you want to extrapolate the most out of that while still being in the trade. So if we actually go and take a look at the trade, this is a spot where, again, your confidence has to be very high and it's used by high leverage traders to willingly take high risk because they believe a larger move is going to support it. This has to do with hard closes. A level can deep dive and maybe not. Maybe it doesn't hard close. Maybe it goes down 30% before moving up 80% or 100% or multiple hundreds of percentages. And if we hit play here, you can see how this would have played out. Oh, that's too far gone. We need to rewind this a little bit. Go back to right here. Maybe go to a 1-minute chart to see how this unfolded and played out. And we can go one candle at a time to see, oh, okay, this level is pretty much hit at this point. It's front run a little bit. Or if it's not hit, it's hit there. Tries to regain the level, does temporarily, goes after the second level there, and trend all in one. Oh, this is looking not so great so far. And this would be a scenario where if you were using no risk, you'd be out of the trade. But you're confident that this is going to ladder off of that previous moment. So it's going to actually use this as a ladder point to continue laddering up. Again, this is where you would use high risk because you want to see if that ladder is going to hit. You'd use the most extreme moments, use high risk, and there's the 4-hour level, hit to perfection. This is a 4-hour reverse level. You would have been, what was the price? 47.25. In this case, it hit 47.25 and 1 cent. So we actually nailed this one. 39-cent difference. Not bad for 100x trading, huh? And then it immediately moves up after that. It immediately moves up after that. There we go. I got it out. You would be in a scenario here where if you're triggering out from this previous level, at 60% being liquidation, you might want to have that extra room as a high risk stop loss to hit an extreme level. So high risk is often correlated with a high risk stop loss is often correlated with high leverage traders who are very far advanced down the list of what they're doing in trading. And they're very confident that this latter point will actually support the move based on the reverse level, which would have been the correct decision in this moment. Now let's take some time to talk about the do's and don'ts of stop losses. Always use a stop loss on every single trade, no matter what. Always identify before a trade where your stop loss is going to be and what type of stop loss it's going to be. Always reanalyze your trades when a stop loss is triggered. It will make you a better trader by going back and saying, hey, my stop loss got triggered. Why? And what can I do better next time? Use all your tools to assess where your stop loss should be. You'll get better with this over time, but just remember you have a lot of tools in TradingView to use to help you analyze your stop loss. Always use self-talk to reinforce your decisions. Now, this is the practice of speaking out loud when nobody or people are around, and you may look a little crazy at times, but trust me when I tell you, it is critical to analytical thinking and will help you leaps and bounds become a better trader and a better overall critical thinker. An example of this would be if I'm looking at a trade and there's two levels, I would go, and I would say this out loud, regardless if people are watching me. And people have seen me do this on stream before. People have seen me trade live and seen me do things where I'm talking what seems like I'm talking to nobody, but I'm actually just talking to myself through my decision points. So what this looks like is, okay, Cotton, what are we doing here? We got two levels. If I buy the first level and it hits the second level, I'm going to get liquidated because I'm a leverage trader. Okay, that means the first level is not that great. The second level, though, I don't really think it's going to get hit because there's too much of a gap and I don't want to miss the move. I wonder if there's a trend anywhere. Oh, darn, I just found this trend. Okay, great. This is in between the first and the second level. If I use this trend, it means that I don't have to take the risk of the first level. And the trend itself is actually not within a liquidation range of the second level. So I can actually play this trend. I don't get liquidated if it goes to the second level. And if the trend or the level supports it, which the chances are very high, it means in all scenarios I'm making money and I'm not missing the trade. Jesus, I think I just found the perfect spot to buy this trade on trend where I don't have that much risk and my chance of success is extremely high and I'm not going to miss this trade. So I kind of fire on all layers of what could be executed in a trade. And therefore I've self-talked my way to making the correct decision in the moment by using positive reinforcement and talking about it throughout my trade so I don't miss anything and I'm actually exploring and uncovering every possible scenario. Last but not least, use the measure tool often. Whenever you're looking at stop losses, your measure tool where you measure how much percentage is in the trade, how much percentage you could possibly lose or make on a trade. This is your best friend. I'm not going to give you one technique and one set hard rule to use it. Just get used to using it. Mark a stop loss, start measuring how much deeper it can go, measure how much money you can make. Just get really familiar and very comfortable with using the measure tool to say, okay, I got a stop loss here. If it goes down to this level, I'm going to lose 20%. I'm going to lose 10%. I'm going to lose 15%. I'm going to lose 30%. I'm going to make 40%. I'm going to make 80%. Use that measure tool like it's going out of style. Get used to it. Use it all the time. Even if it feels like you're just spamming this thing, go ahead and spam it. You're going to be a better trader if you do. It'll teach you good techniques and proper methods in the long run. It'll build great habits for you. Now let's talk about some of the don'ts and the do's and don'ts of trading. Don't separate the importance of your stop loss based on position size. All stop losses are equally important. They don't change in value based on the size of your position. Accuracy isn't affected by how much you put in the markets. Don't create sub-strategies off the importance of a trade. All trades are important, win or lose. You should take them all equally and serious as they're all just data points on our screen that have an equal relevance. They don't have a more or less important point where it makes the move up higher or lower. They simply are data points on a chart and they should all be treated equally. Equality in data points. Boy, that's something, isn't it? Let's do that. Don't put using a stop loss off for later. This is critical in becoming a high level trader. And even as beginner traders, it's one of the very first tools we need to learn how to master. You will be using a stop loss like you hold your wife's hand through life. You'll be using it from the very first steps you take all the way to the end of your journey. A stop loss is right there hand in hand with you as a beginner trader, as a trader who's growing, medium, high level, elite professional, top tier, billionaire. Every single tier uses stop losses. Don't ever forget it. Don't put this off. Don't use trailing stops. I am going to get flamed out of my mind for this because people love trailing stops. It's their savior. It's how they lock up profits and move on to the next trade. Let me tell you something and break it down very clear for you. If you are using a trailing stop, you are admitting defeat. Why would you take out part of your position if your target hasn't been hit yet? Why would you need to take out 50%? This screams, I don't know what I'm doing, so I have to take what I can because I'm not confident in my targets. If you believe your target is hit and the trade is over, all out. If you believe that your target is still to come, stay in your trade. You don't need to trail out. You're taking smaller amounts of profits because you're not exactly sure what's going on. So just like a medium risk stop loss, this is completely useless. Trailing stops are just a crutch for newer traders. Every single pro and high level trader that I know, 7-figure incomes, 8, 9-figure incomes, they don't use trailing stops. Some use different tactics, but I promise you that using a trailing stop is just admitting you don't know what's going on. And by common logic, if you're taking part of your position out, but willing to leave part of it in, aren't you just admitting that, hey, I don't really know where this thing is going, so I gotta take the cash that I can? Because if target was truly hit, you would take it all out instead of losing more. If target hasn't been hit yet, all you're doing is taking less by not being fully in the position. So whether it's still going up or it's still going down, it's a loss-loss scenario. Don't use trailing stops. If you do, realize they're a crutch and get away from them as time goes on. Never walk away from your trades without a stop loss. Never. And when I say never, I mean never. I mean, I don't care if you have to kick over a chair to get that stop loss on the board. You get that stop loss on there, or you don't enter the trade. If you have time to enter the trade, you have time to enter the stop loss. If you have time to enter the trade, but not the stop loss, you don't have time to enter the trade. Hand in hand, like I said before, walk through life with your stop losses. You never enter a trade without one. Don't feel negative when your stop loss gets triggered. Millionaires, elite traders, stop losses getting hit is a part of everybody's routine. The best in the world have stop losses hit. Don't feel negative when yours gets hit, like you've somehow failed or this somehow sucks because you were wrong. This is a tool that professionals and the most elite traders in the world use to protect their account. It's a tool, a safeguard that is used by everybody who's anybody in trading. So don't feel negative about it if a stop loss gets hit. It's just like a hammer. Any great builder needs to master how to use his hammer before he can actually build something like framing or put up a wall. This is just another tool for a day trader. It's not a moment of defeat. It's not a moment of lesser. It's not something where if your stop gets hit, it makes you a worse trader. Actually, if your stop gets hit, it makes you a better trader because it means that unlike most people, you're actually using one. So again, just remember that a stop loss is a tool used by every single great trader in the world, and they get hit. And they are there to protect us and protect our account. Don't be caught without one. What's that old saying? Don't ever get caught with your pants down. This is the trader saying, don't ever get caught without a stop loss. So I hope this guide has helped you guys understand the way in which we take these trades. The most important thing is defining the amount of risk you want to take. So whenever we look at a stop loss, we're not looking at a stop loss to say, hey, I enter here and I'm just going to stop there. We never use kind of these static things like, 1% or 5%. Instead, we use the data points on our charts and the amount of risk that we want to have associated with trades to dictate where a smart stop loss would be. Whether we're willing to take no risk because we found polarity moments, or whether we're more confident that something is going to go up, and that equates to using either low risk or high risk, depending on the leverage you use. And for beginner traders, medium risk, we've really been able to create an engine today that allows you to look at stop losses in a way of levels tell you what to do with your stop loss. Trends can tell you what to do with your stop loss. Stop losses aren't something where we pick a spot on the chart and then we just have 1% error room. This is completely the wrong way to look at stop losses. There's data points and charts that give us exact moments where it will tell us what the risk should be and what type of trade it's going to be. So by using data points and engineering a science and creating this engine and system that we can use all these things in cohesion to give us almost this automated stop loss process where it becomes very straightforward, the amount of risk we're willing to take and where we're willing to take it in every scenario, no matter what skill level we are, or no matter how much the price may move up or down. Like I said in the beginning of this video, it doesn't matter if you're a regular trader, an investor, a day trader, All of these must master stop loss. And if you do, well, I think you can see how you can limit your risk to nothing and have complete control and sleep maybe a little bit better every single night, as that's one of the big challenges as a trader. I'll see you in the next video. Take care. I hope you enjoyed this.